All right, today we're going to dig into a world where billions of dollars are literally bet on finding treasure buried deep in the earth. It's a business of huge risk and just maybe colossal rewards. And to manage that whole financial story, there's a really unique and honestly fascinating set of accounting rules.
So let's just start with the main question, right? If your company spends, say, $1 billion drilling for oil or mining for gold, but there's absolutely no guarantee you'll find anything, how do you put that on a balance sheet? Is it just a massive immediate expense that tanks your profits? Or is it an investment in a potential fortune? That's the puzzle we're going to solve today.
Before we dive into the rules, you've got to appreciate the game. And in the world of mineral exploration, it is the ultimate high-stakes financial gamble.
I mean, think about it. You're spending massive amounts of money up front with zero guarantee of a return. You could drill a dozen dry holes or even 100 before you strike it rich. Or you might just find nothing at all. Your standard accounting rules, which, love certainty and neatly labeling things as an expense, they just don't know what to do with this level of uncertainty.
So, to solve this very specific accounting headache, the world of international finance came up with a special rulebook. And that is where we meet IFRS 6.
So IFRS 6, that's International Financial Reporting Standard 6, is basically designed to bring a little bit of order to the wild west of exploration finance. It's a very specific guide that tells companies exactly how to account for their spending while they're out there, in the thick of it, searching for things like oil, gas, and precious metals.
And the real power of IFRS 6 is its laser focus. It doesn't cover the whole journey, not at all. It only kicks in after a company gets the legal right to explore, and it stops the very moment they can prove that a find is commercially viable. It is the rulebook for that critical, super uncertain, and, let's be honest, exciting phase right in the middle.
So if all this spending on exploration isn't just treated like a regular expense, then what is it? Well, this is where IFRS 6 gets really clever. Instead of immediately writing off all that cash and taking a massive hit to the bottom line, IFRS 6 lets companies bundle it all together into something called an exploration and evaluation asset. Yep, you heard that right. In other words, the money you spend looking for the treasure is treated like a potential treasure itself. So what exactly gets to go into this special asset bucket? The standard is actually pretty specific. We're talking about the cost of getting those exploration rights in the first place, all the geology studies, the exploratory drilling, the sampling, even the cost of figuring out if what you found is a real commercial opportunity. And IFRS 6 is actually pretty flexible here. These assets can be classified as either intangible, think of the legal rights, the piece of paper that says you can explore an area, or tangible, like the actual trucks and drilling rigs you're using. And this distinction matters because it changes how these assets get valued over time. Okay, so the company has spent millions, maybe billions, and now they've got this impressive-looking asset on their balance sheet, representing all that potential. But, an asset is only as good as its future, and that brings us to the moment of truth. This is the question, isn't it? The one that keeps investors and executives up at night. You've got all this hope and all this capital just bundled into a single line on a financial statement. Did the bet actually pay off, or was it all for nothing? Well, there are really only two paths from here. On one side, you have success. The company proves the discovery is viable, and that exploration asset gets a promotion. It's reclassified and moves into the development phase, beyond the world of IFRS 6. But on the other side, you have failure. The search comes up empty, and the asset now has to face a harsh reality check, an impairment test. Now, impairment sounds like a complicated accounting term, but it really just boils down to a simple and kind of brutal question. Is this thing now worthless? It's the official process to figure out if you're ever going to get your money back from this project, which for an investor is a massive red flag. And you don't just get to decide when to do this test. IFRS 6 lays out some very clear triggers. If your right to explore is about to expire, if you've stopped budgeting any more money for the project, if you officially abandon the search, or if the data just flat out shows it's a dead end, then it is time to test that asset's value and very likely write it off the books. This whole journey, from investment to asset to potential success or failure, it's a high-stakes financial story. And it's a story that companies are legally required to share transparently with their investors. And that transparency is absolutely crucial. The standard itself says that the whole point of these disclosures is to help people like us, understand the amount, timing, and certainty of future cash flows.
Basically, it's all about giving investors the tools to really understand the risks and rewards. So what exactly do companies have to tell you? Well, they've got to lay out their specific accounting policies, they have to tell you the total dollar amount of their exploration assets, and all the income, expenses, and cash flows tied to those activities. It's really about giving you a clear, honest picture of what they're up to.
So this is what we're left with. Thanks to IFRS 6, that line item on a balance sheet, exploration and evaluation asset, is way more than just a number. It's a story of hope, of risk, and of huge investment. But the standard also gives us the rules to know when that story might be over. So the next time you see that on a company's financials, you'll know to ask the really important question. Is that a future gold mine, or is it just a very expensive hole in the ground?